Ladies and gentlemen, today I will analyze how the Federal Reserve's monetary policy shapes the trajectory of the U.S. stock market, exploring the mechanisms through which interest rate decisions and balance sheet actions influence investor behavior and equity valuations. Thank you for reading our news. Please like and follow us for daily news updates. Current rate environment. Since mid-2022, the Fed has raised its policy rate aggressively, bringing the federal funds target to a range of 5.25% to 5.50%. This higher-for-longer stance reflects the Fed's commitment to returning inflation toward its 2% goal, even as labor market strength surprises to the upside. Transmission mechanisms. When the Fed tightens, short-term borrowing costs rise. For banks, businesses, and consumers, higher rates increase companies' debt service expenses and can dampen profit margins, especially for highly leveraged firms. At the same time, mortgage rates and consumer loans become more expensive, cooling demand for homes, autos, and discretionary goods. Market reactions. Equities typically respond in two phases. First, uncertainty around the Fed's next move can trigger volatility spikes as traders repriced rate-sensitive sectors like financials and real estate. Second, once a rate decision is delivered, markets often recalibrate based on forward guidance. A hawkish statement can trigger broad-based sell-offs, while hints of a pause or eventual rate cuts can spark rallies, particularly among growth-oriented technology stocks whose valuations hinge on discounted future earnings. Forward guidance and balance sheet policy. Beyond rate choices, the Fed's communication strategy is crucial. Clarity around the dot plot projections and quantitative tightening pace helps set investor expectations. When the Fed signals a potential pivot, either slowing balance sheet runoff or contemplating cuts, it tends to lower long-term yields and boost equity multiples. Conclusion. In summary, the Fed's monetary policy shapes the U.S. stock market through direct changes in financing costs, shifts in investor sentiment via forward guidance, and balance sheet operations. As markets weigh the timing and magnitude of future rate moves, investors must monitor incoming inflation data, labor market trends, and the Fed's own communications to navigate the path ahead. Thank you.